if you're in business or thinking of starting a business or an e-commerce business, and even if you never want investment and you never want to sell, but maybe you do, you should always run your business as if you were going to sell, as if you were going to invest. Because here's the deal, even if you never seek outside investment, guess what? You're an investor. You're investing your time, you're investing your money, and all the people that work with you and work for you are doing the same. And so if you look at that as outside investors, then you'll actually create a business that is more profitable, that is more valuable in the end. And so depending on whatever your plan is, your investors may look different. So today, what we're going to talk about is how do you position your e-commerce brand for a capital raise, for an investment, for a sale, and what are 5 traps to avoid when doing that, even if you never want to do that. Because guess what? If you do these things and you avoid these traps, then you'll actually create a more valuable business. And why am I qualified to talk about this? Well, we've been helping grow e-commerce brands for over 12 years, and we actually own a venture fund for e-commerce brands. We actually buy, sell, and grow these brands. We actually help investors do that as well. We have a lot of experience in this area. And oftentimes early brands don't have this experience. And so today I want to talk about those 5 traps. Now, first, the different investor types. And it's important to understand that depending on where you are in your seeking investment, where you are in your business stage, you might look for different types of investors. And so there are 3 types that I wanted to mention for context today. The first is an angel investor. And if you're just starting a business, let's say you have an idea for a consumer product and you want to start that, the best option, and you're looking for outside investment, the best option is to look for angels. Angels are people, they may be friends, family, or relationships that actually are willing to give you money for equity in that company as a startup. And again, they're willing to risk it on you. And if it doesn't work out, then they are out their money. But that is the place to start. The second is venture. And I see a lot of e-commerce brands going to VCs potentially with their ideas. And the truth is that typically VCs are, while they do invest in startups, they're investing in typically billion-dollar ideas. Like that's what they're looking for. They're looking to invest big into something that could go giant. And for direct-to-consumer brands, that is not always the case. And so it's usually not a right fit for venture. And the third is growth, a growth investor. And that's actually what we are here. A growth investor is someone who looks for investing in some traction that's already happening and pouring fuel on the fire. And so that might be founder that has gotten the brand to a certain level and wants to exit, or wants to partner with someone to actually grow it to the next level. That is a growth investor. And that's that third type of investor, and probably the one that would be the one to exit to, or might be the one that would actually come alongside you and help pour fuel on the fire that you're already creating and the success that you already have. And so let's get into the 5 pitfalls and how to avoid them if you're looking to position your company as a brand that can do a capital raise, can exit, or can bring on investment in the future. Again, even if you never do, avoiding these pitfalls will help your brand tremendously. So trap number 1, expensive and complex products. And so we often talk about how large margins are the lifeblood of a successful, healthy e-commerce business. Healthy growth is based on healthy margins. And we can link to a bunch of resources on how to do that, how to make sure you're doing that below. But this is what allows you to do everything else. If your margins aren't good, and by good, I mean 5 to 30 times your cost of goods, then the entire business model kind of crumbles or can go really slow and not really produce the results that you want. It also creates a huge cash outlay, which for investors is not very attractive. In fact, investors generally aren't interested in investing any of your investing in any of your inventory. Investors are typically interested in investing in growth. And so if there's a large cash outlay in your product line and your margins aren't good, then that is not what looks good to an investor. And so high margin products are more likely to cash flow, which is also another plus. And so you should be sure to create products that are simple, that are profitable, and that are really good products. Like they produce results, they actually fulfilled their promise, and customers love them. Trap number 2, no bold position or clear big market opportunity. Look, brand is critical, and your uniqueness and the way you stand out among your competitors and in the market is critical to your success as a business, and an investor will see it the same way. Also, a great brand and a bold position in the market is what we call a moat, and investors like moats. Moats are, those things that you dig a trench around a castle and put alligators and water in it, like that's a moat, right? It protects you. Investors like moats, and a brand that has a bold position and a clear market opportunity is an asset and is a moat that is really hard to compete against. And so investors are looking for return, which is obvious, and they want a good return. So the upside should be as big as possible. I just mentioned VCs. VCs are known for wanting to invest in billion-dollar ideas only, and they're actually not interested in any smaller ones, even if they're really great ideas. Investors, while they're all not looking that way, are looking for a great return. And so you want to make sure that the opportunity is clearly big and that you also can communicate that really, really well. Make sure that you dig hard into the pain that you solve. Look, the more expensive the problem for the customer, then the more valuable your solution to that problem. The bolder the stance that you can take in the market, the more successful that your marketing will be. And so look for a bold stance with a great opportunity and how you can communicate that really well. Okay, trap number 3, vague or no specific success in your marketing. So traction, especially for investment, is key. This is where you can go from not being a valuable company to being a valuable company, no matter what your product is. Like, even if it's a great product, doesn't matter. If you don't have any traction, then your value is way less than if you have traction. So success is key here. Cost of customer acquisition, or customer acquisition cost, CAC, is critical to know at this stage. And the deal is, marketing is like, it's a combination lock, and it takes time to figure out. And so if you haven't figured that out, then it's not very attractive to invest into. If you don't have any traction, or you haven't found some marketing that's working, investors are not interested. So here's what you do. Work on creating a great product with a great story and showing that it's validated in the market with successful marketing. All right, trap number 4, high shipping costs. Shipping is obviously critical in e-commerce, right? To create a great brand, you need a great shipping experience. And shipping costs money both ways, right? When you send it to the customer and when they send it back, or if they send it back, which that happens a lot of in e-commerce. And so big complex items that are expensive to ship and are expensive to cover for return, and especially if they break a lot, right, in shipment, those are not things that investors are very interested in. Those are not things that are foundations to profitable brands. It doesn't mean you can't have a valuable brand if you have expensive shipping or you have a product that can break. It's just a lot harder. And so what you should shoot for is simple, low potential damage products that have a low cost to ship. And that way you can create a great customer experience at a low cost, and also a great experience if they need to return it back, and you can create a great warranty as well. Trap number 5, no customer maximization plan. We often talk about how product line strategy and your brand ecosystem is the key to getting to a profitable level, especially if you want to get to a 9-figure brand level. This is how you increase revenue without marketing costs, without increasing your marketing costs. And so in your world, you need to work on creating a customer maximization strategy, how you're going to take a customer in and exponentially maximize their revenue in your brand. Create that with intention, your entire model, and make sure it's very clear with numbers. If you do that, you can actually create a lot of value in your company and make it really attractive to investors. Trap number 6, you don't know your metrics that matter. Metrics that matter are critical, and we talk about how to find those and what they are. We have our golden metrics for e-commerce, which we can link to in a bunch of different places. But these are things like average order value, conversion rate, lifetime value, profit, acquisition cost. These metrics are important, that you know exactly what they are and that you know exactly where they need to be in order to achieve your business model to create profit in your e-commerce business. And so make sure you know that what these metrics are, and make sure you know how you're going to improve them. Trap number 7, you don't know your customer and your competitors deeply. And so knowing your customer deeply should actually be number 1. And we talk a lot about how you can know them deeply with an e-commerce customer avatar. We can link to resources as well. But their pain, the customer's pain, is what drives the need for your products. And so knowing them deeply is really important to having a successful business. And then the gap between their pain and how they're solving it with your competitors is actually a really important part of your business strategy. And so knowing your competitors and what the gap is critical to how you position your product and your brand and how you improve your product over time. Go through our customer avatar, make sure that you know your customers at a very deep level. Make sure you know who your customers are, how many there are, how many different avatars there are, and make sure you do a SWOT analysis on your business, including a competitor analysis, knowing who's out there, what are they doing really, really well, and what are they not doing well, and that will actually position you for success. And so look, even if you don't plan to raise money or sell your business, you should still run your business as if you will do those things. It will make your business better and make it more valuable. And look, if you're a brand that has some traction and would like to consider an exit or investment, contact us at Metacake and at Doe Capital. That's doe.capital. And we'd love to see if we're a good fit. Thanks, and never stop growing.